Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing position sizing, the gambler's fallacy. We're going to commit this video to explain a gross misconception about streaks. The majority of traders tend to think that the chance of the next trade being a winner or a loser depends on the previous events. That means people feel that long streaks have a high probability of ending in the next trade. That belief is wrong and makes many traders think that adapting his position size to the recent performance is the right way to go. Now we will discuss dependent or independent probability events. What is a dependent probability event? A dependent probability event is an event whose probability of outcome depends on the previous results. For example, the likelihood of getting an ace on a deck of cards depends on various draws. The initial probability is 4 in 52, but as the game evolves and more cards are drawn, it will depend on the number of cards left and the number of aces drawn. So if the deck has currently 41 cards and one of the aces has been drawn, the odds of the next draw being an ace is 3 in 41. Independent probability events. An independent probability event is an event whose probability of outcome does not depend on the previous results. The odds of a fair coin resulting in heads or tails is not dependent on the previous result, even when many people believe that the streak of heads has a higher chance of ending with the next move when the last play was a tails. In fact, the odds of the end of the streak are the same in all situations. No matter how long the streak, it's 50-50. Trading is a game of chances. The question is now to decide if a trading strategy is a dependent or independent process. That is a very interesting question, and it is difficult to answer with 100% accuracy. The majority of strategies are independent processes, meaning that the next trade outcome is not dependent on the preceding trades. That means it has no memory. Also, to prove a trading system is dependent is very hard to accomplish and is left to errors. Modulating the position size. It would be nice to trade a dependent system. Imagine you know the odds of a win are higher when the previous trade was also a win. You could increase your position size after a win and decrease it after a loss. On a system in which the odds of winning after a win drops, you could do the opposite, reducing your position size after a win and increasing it after a loss. But modulating the position size can be wrong if the trading strategy or system shows independency, and that is what is called the gambler's fallacy. People tend to believe that the odds of the next move change with the past events. In fact, it did not. That makes them adapt their position size in the wrong way. They tend to reduce their position size during large winning streaks and increase it during losing streaks, expecting a winner soon. This is the opposite of cutting losses short. Streaks cause doubt in traders. The majority of traders follow this strategy with little confidence, since they do not fully understand the statistic principles behind streaks. They sometimes abandon the system after 4 or 5 consecutive losses, thinking that the markets have changed or that the system's testing was not as good as they thought. Changing the risk. Another dangerous situation might occur on a winning streak in which the trader might think that his system is infallible, thus increasing the size and risk levels to the next trades. In his definitive guide to position sizing, Van K. Tharp explains a curious situation that happened when they were testing their position sizing game. The game was set to 60% winners, and where 55% of the time they won what they risked and 5% of the time they won 10 times their bet. One of their testers had an incredible 23 winning streak. After winning 10 times in a row, the tester then began to increase their trading size from 10% to 95%, bringing $10,000 to $1.45 million in 23 trades. On trade 24, the tester risked $1 million and lost, leaving the trading account balance with just $45,000. The lesson here is evident. Events that are subject to the laws of chance have winning and losing streaks. These will defy the common understanding of people. We should leave a more in-depth analysis of streaks for another video, but suffice to say that the odds of a streak conditioned by the probability of a single event. The odds are out there. Take a look at this explanation of a probability event. It means that the larger the probability of a single event happening, the higher the odds of a large streak. Translated to the trading world, a system with a high percentage of winners will have a short losing streak and extend winning streaks. The opposite is true. A trading system with a low percentage of winners will suffer large losing streaks. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.